very brave. Every experience only positions companies stronger going forward. Where there is a will, there is a way. I can feel the determination of the Indian government. I'm very optimistic of where it will be headed. Prime Minister Modi once mentioned to me that IT stands for India and Taiwan. Honorable Prime Minister, Taiwan is and will be your most trusted and reliable partner.
The reports of Foxconn EV plans come just days after Elon Musk-owned Tesla indicated that India may be the hub of its EV supply in APAC and Africa regions. Business Today TV had earlier broken the news that Tesla was also looking at manufacturing a $20,000 electric car in India, the cheapest in its portfolio. Bureau Report, Business Today Television.
Hello and welcome. You're watching Business Today TV. This is Market Today and I'm Sakshi Batra. On this edition, we'll discuss all about markets from the benchmark index moves to sectoral action, the stocks that are buzzing in trade, and also we will understand what are the implications of the latest report of Morgan Stanley where it has given an overweight rating to India. Vis-a-vis China, what does it really mean for India? We'll understand all of that with an expert who will join us just in a bit. But first up, a quick check on how the markets are doing as we are looking at the first half of trading action being passed through. So you can actually look at the Nifty and the Sensex now extending their fall from the morning trading session. 400 points now down for the Sensex at 65,375. The Nifty is now also hovering near 19,400 odd mark, down about 100 odd points or a half odd percent lower in trade. The broader markets, let's look at the Nifty Bank also extending the fall, now 0.85% down in trade. The mid and the small cap indices, let's look at those indices also and see whether the fall has escalated there. The mid caps are absolutely flat right now actually. So they're doing much better than the benchmark indices, just about 0.04% of a decline for that one and 1/10% lower for the small cap 100 index. But the broader indices, if you look at the Nifty sectoral indices, barring the pharma, healthcare indices, rest of the sectors are still under pressure. It's the pharma stocks that are definitely shining the brightest today. Among the top gainers on the Nifty pack, you will see a lot of stocks from the pharma pack again today. Sun Pharma, Divis Laboratories, these are the stocks that are topping the charts. Adani Enterprises, of course, is up in trade amid the Adani Cement acquisition of Sanghi Industries. Aisha Motors and NTPC, the other stocks that are moving up in trade. On the downside, however, you do see Titan post the earnings looking at a 2% decline. Tech Mahindra down 2%. ICICI Bank, TCS as well. And also ONGC, that's slightly down in trade. But time to welcome our guest on the show. Mr. Avinash Gorakhshakar joins in, Director Research at Profit Mart Securities. Welcome, sir, and thank you so much for taking the time out for this discussion. I want to begin by first understanding your own sense on the markets. In the last 2 or 3 odd trading sessions, we've seen, everything that could perhaps go wrong for the bulls take place, starting from the Fitch downgrade in the US, the kind of updates we've been getting from the Eurozone and China as well on the manufacturing updates, and now we're looking at some of the other concerns also weighing heavily as far as the profit booking is concerned, the FII outflow for the last 4 or 5 trading odd sessions. But help me understand your sense. How are you looking at these current developments, and is this something to be worried about in the long term, or will this just pass through after some bit of consolidation in the markets?
Yeah, I think, Sakshi, first of all, thank you for inviting me. Most importantly, I think the markets were looking for some reason for getting a healthy correction. And I think the Fitch downgrade, which happened yesterday, I think clearly ensured that the markets corrected quite significantly. In fact, today also we are seeing a little bit of pressure because liquidity from the FIS is also, getting curtailed. But my sense is that overall, if you look at the structure of the market, I think corporate results up till now have been quite encouraging. And I think if you look at the numbers, the commentary, the quarterly numbers have been pretty encouraging, except some sectors like IT or chemicals, where the numbers have been extremely, disappointing. but these were on expected lines. So my sense is that the markets could possibly remain volatile for a few trading sessions, but this is just a knee-jerk kind of reaction. There's nothing to worry in the longer term. And obviously, in the longer term, I think it's going to be data points and the India macro growth story, which is going to be, being looked upon by a lot of foreign institutional investors. In fact, today a report from Morgan Stanley has clearly upgraded India and downgraded both Taiwan and China. So that clearly spells out the mood amongst the FI community. Longer term, we still continue to believe that India is a very good growth story. But in the near term, we could be looking at the market consolidating. And I think it's better to take a stock specific view based on the corporate results which are now coming out.
Sure. Now let's shift focus to the news that has come in today, and on Morgan Stanley, the brokerage firm has now changed India's status to overweight now, as it believes the nation's reform and macro stability agenda supports a strong capex and profit outlook. So I want to understand, what does this news really mean, especially when this comes at the backdrop of US losing AAA status and the economic slowdown in China?
No, I think clearly, as I mentioned earlier, obviously allocations to India is are now going to increase quite significantly because a lot of brokerage houses, a lot of index-based funds actually follow the Morgan Stanley, MSCI index plus the view, from the Morgan Stanley broking house. Clearly, this is a very strong statement putting India as an overweight category and down playing Taiwan as well as China. In fact, in their report, they have clearly said that the infrastructure sector and the building sector is definitely going to see a lot of action in the coming few quarters. They are very positive on the earnings growth trajectory, and they believe that there is immense growth opportunity for this earnings momentum to continue. Even we believe that earnings growth for FY 23-24 could easily be 18 to 20 odd percent, and I think there could be a lot of positive surprises in the second half of FY 24. Plus, the government's macro numbers are improving gradually. GST numbers are pretty strong. The trade deficit is well under control. So I think all said and done, this report highlights the fact that India needs to be upgraded, and obviously this is going to mean a lot of FI money is going to flow in over the next few quarters.
Correct. And for all the viewers, also remember that this latest upgrade comes 4 months after the first upgrade by Morgan Stanley, where it moved India up from underweight to equal weight rating, citing a resilient economy as well. So that's another positive, that we've seen a second upgrade coming in just in 4 months as well. Now, Avinash, when we talk about the top emerging markets, especially India versus China, Morgan Stanley clearly in its report says that India is arguably at the start of a long wave boom. At the same time, China may be ending one. So how do you read this in terms of where are both the economies really heading?
So I think just to give you a small mention about China, see, the Chinese economy is under a lot of stress. What we hear from reports is that commodity prices have come down. China's manufacturing sector is also struggling, and I think there are recent reports that Chinese government would obviously look at putting a stimulus now in order to ensure that the economy again takes off. So I think there are very clear signals that the Chinese economy is not going to grow significantly, at least in the near term, and a lot of FI money and allocations from global investors is going to move towards India. India, on the other hand, if you see, is gaining strength from strength. Our currency is stable. Our trade deficit has also been under manageable kind of number. Most importantly, the GST number has now steadily increased to roughly about 1.6 lakh crores on an average every month. And most importantly, corporate capex is going on in a very big way. This clearly, signifies the kind of confidence, corporate India has now on the growth story. And specifically, I think domestic market is a very large opportunity. Export sectors may underperform for some time, especially metals and IT. But the domestic sectors are well poised for growth, and I think that is what has encouraged large investors like Morgan Stanley to upgrade India to overweight position. So I think we are yet to see a very strong kind of trajectory in the earnings growth numbers, which for a long time has underperformed.
Correct. But would you also say that, now that you say that, of course, FII money could flow towards India, earlier the preference was clearly China for most of the FIIs. Do you think some of that allocation also could shift to India now? What earlier was planned for China, looking at a better trajectory, better economic conditions for India?
Yeah, I think FI flows could increase. In fact, a lot of FI allocations which were planned for China have already started moving into India. Most importantly, until China really shows signs of a turnaround and a bounce back in their economy, I would not be surprised that global money, especially FI money, will not get into China that easily. They would take at least maybe a couple of 2 or 3 quarters before growth resumes back again. But for India, it's a good opportunity because we are growing solidly, and I think growth momentum has just started. So I think you're going to see a lot of strong traction in FY24 as well as FY25, and that's what is attracted most of the global investors.
Right. Now, Morgan Stanley has also given sectoral overweights as well, especially to the Indian industrial sectors, financials, consumer discretionary stocks. Are these the sectors that you're also positive on for all those investors who've been waiting for dips? Now that the dips are happening in the markets, is this the right entry point, and where exactly should they be now allocating money?
I think we have also always been positive on the capital goods sector, which actually also means the industrial sector. We've also been positive on the automotive and the banking sector. In fact, the banking and the financial sector has been one of the strong performers in quarter 1 of FY24, whether it's a private sector or a public sector bank, or whether it's a microfinance bank or a small finance bank. Almost every NBFC also has delivered very strong numbers. So our sense is that yes, financials could be a sustainable kind of favorite area, which could possibly lead to a good risk reward, for investors. Considering that credit growth in the economy is pretty decent, around 12-13%, and that should help all of them to increase their balance sheet. So I think in this market, I would suggest that one should use the dip in the market to actually accumulate positions in quality stocks, especially from the capital goods sector, from the automotive, auto components, and obviously from the real estate and the building product sector. I think these are sectors where I see a lot of growth opportunity happening. The second and third quarter would equally be strong, and depending on that, I think you could see gradual re-rating in these kind of sectors.
Understood. Let me shift a little bit focus to all the stocks and sectors that are moving up on news flow. Let me first ask you a reaction on Varun Beverages. We've just seen the results really come out, where the Q2 results, the net profit has jumped about 25% to over 1,000 odd crore rupees. We've also seen the stock really perform very well in the recent past too. Your own sense of Varun Beverages at about 824, 825 odd rupees. It's up by 2% after the earnings. Last 6 months, a strong run up of 43 odd percent on the stock. Is it still, in the buy zone after the kind of earnings that we've seen?
So I think, see, numbers which have come out have been pretty encouraging, and I think Varun Beverages obviously is a pan-India player and a franchisee for Pepsi. I think in India the opportunity is very large, considering that the market is monopolized by one or two players. Obviously, in a tropical hot country like India, I think beverages are definitely something which are liked by the masses, and I think Varun Beverages has done a decent job by launching a lot of new products for the youth category also. So I think you're going to see a lot of growth trajectory coming in over the next say 12 to 18 months. This is not a cheap stock, but yes, the growth potential is very huge, and obviously somebody who wants to take a medium to long term view can obviously accumulate at the current odd level.
Understood. The other corporate development that's happened today, of course, is from the Adani Group and Ambuja Cements looking to acquire, Sanghi Industries. The details have come about. Enterprise value of 5,000 odd crore rupees, 114 rupees per share, etc. 3 to 4 months the acquisition time. But what does it really mean for the entire cement industry, and how does one really play this story in case one has to play this? Because you've already talked about industrials, capital goods as your preferred bets. As an ancillary cement space, how do you look at this space and the best plays according to you?
I think the best play from the large cap cement space is obviously Ultratech and Ambuja Cement. We believe that these are two geographically large players, and as far as this acquisition is concerned, Sanghi Cements has been acquired at a very attractive valuation of 5,000 odd crores. Our sense is that the shareholders of Sanghi would also benefit, considering that in the industry now consolidation is happening, and this is good for the overall health of the entire industry. I think it would bring in a lot of pricing power. It would obviously help the industry grow better, and some kind of undercutting amongst players would also stop. So to that extent, I think I'm clear that if infrastructure in India grows, then cement is the first building block, and you could see better numbers from the cement companies, especially which are geographically pan India based, and that could happen from the second half of this year. So I think this year, frankly, the volume growth in the first quarter was quite remarkable, although prices did not go up. In the second half, we are expecting that prices also will also move up, and the volume growth also will be steady. So this benefit will obviously lead to better margins and profitability for the entire cement sector.
Okay. Another comment that I wanted from you was on Indigo, especially after the earnings. Now, we've seen the highest ever quarterly profit being reported for the company, but the stock has reacted down. Is it just profit booking? Is there something else that the street has not liked into the earnings?
No, I think it is partially profit booking because the stock has already risen quite significantly in the past few months. Most importantly, please remember that Indigo is a market leader enjoying a market share of almost 50 odd percent. Plus, they have now ordered more than 100 more aircrafts to actually increase their geographical coverage. So my sense is that this growth momentum will continue with the tourism and the hospitality sector doing very well. Business travel now picking up. My sense is aviation traffic will further gather momentum. And I think India is a very large aviation market, which obviously will benefit players like Indigo. So the short term, one could see that post results normally there are price corrections happening. So longer term, I think definitely it's a good opportunity to accumulate, provided you have a medium to long term view here.
All right, understood that. Well, many thanks, Mr. Gorakshaka, for being with us on the show and discussing all these insights about the markets, several pockets where the opportunities still exist for investors. Let's get back to the markets. The sell-off is now escalating. You can again see a 522 points of a decline on the Sensex today. So second day in a row, you're looking at the markets looking at a sharp fall. 0.8% now down for the Sensex, 0.6% of a fall for the Nifty 500 as well at 16,754. The Nifty 50 is down 145 odd points at 19,380. So it's broken below the 19,400 mark. But what remains to be seen is whether we will see a bounce back and we manage to close above the 19,400 mark as well. Because a lot of technical experts do believe that if 19,400 gets broken, then you could see a further sell-off coming into the market. So we'll continue to watch out for all these levels and continue to speak to all the experts to find out what are the key levels you need to watch out for in the markets, what is the right strategy for you, where still could you invest to get the benefits of the markets on dips as well. So do stay tuned onto with us on Business Today TV to catch all the updates from the world of business and stock markets. Don't forget to subscribe to this channel and also continue to engage with us on our other social media platforms like Facebook, Twitter, LinkedIn and Instagram as well. Until then, many thanks for tuning in.